Hey, Sasha, the options coach. Today's video, we're going to take a look at some quick advice. Should you let your puts expire or take profits? So this is kind of the question we've got that I saw on a Facebook group. I need your advice. Say, I have a sell put expired this Friday, but since I already gained 85%, man, that's amazing. Good job. In this situation, should I buy to close or just let it expire? For your info, if the stock drops, I don't mind holding the shares. Okay, so if you don't mind holding the shares, that's fine and great. However, you could actually just roll it to another expiration as well. You see, what happens is if you've got something this Friday, which means, hey, right now we're kind of on a Wednesday, depending on when you're watching this video. But let's say we've got a put contract. I'm just going to go with CRM. Let's say it's this Friday. Let's say it's 2 days out, and let's say it's pretty close. Okay, so it's already gained quite a bit of value, though. You know, you've already gained 85%. Now, this one, actually, as an example, we'll just roll it for that next week. Okay, so let's say I was trying to make $176. Okay, and then I made about 85% on this. So that means either it decayed enough or it went up enough. So the big question is now you've got only a few days to go. Okay, so with a few days to go, this could actually, what you're trying to do is, do you have enough range? Like, what's your delta here? Like, are you really far away and, hey, you just want it to die out? If your delta is kind of tight, like, are you pretty close there, where you don't have a lot of strikes in between? Then you might want to close it out. So for example, let's say you're dealing with this kind of set of strikes and expirations. Well, if you're kind of in this zone at 255, okay, you might say, hey, I'm kind of close. Okay. On the other hand, if you're kind of at 245 and you've got a lot of range, a lot of strikes in here, and the delta is really small and tiny, you know, you've already made quite a bit of percentage, then you might say, well, I'll just let it expire because you don't have a lot of time left. So in general, especially now with the market doing okay, what you could do is to feel it out the next day and just kind of set a stop of 70% instead of 85, and then just move it maybe another couple of weeks. So that's kind of one way to look at it. Another thing to look at is, let's say you had 2 contracts. So if you had 2 or 4 or 6 contracts, you could always take 1 or 2 of them off. So for example, if I was trying to make $185 and I'm up about 85%, well, I could just take a couple of contracts off, and that would secure and lock in the profits. Now, I don't know if you've got a couple of contracts. Maybe you do, maybe you don't. But if you've only got one, then obviously you wouldn't be able to do this. But if you do have a few, you could take half off. That's another opportunity or a choice. The other way to do this is, ironically, you could actually sell the other side. You could sell the call side on it to kind of protect it. It's a little more advanced because now you've got kind of a straddle and strangle kind of concept going on, or almost an iron condor. So you could sell the other side, which helps protect you on a downside move. And then what you've got is, if I did a May 10th over here, you could actually go something like this. And now if it pulls back, you're actually collecting premium on the call side. I know it's a little more advanced, but it's another kind of thing that is possible that you could do. And now you've got something like this happening. So anyways, a long story short is, when we're looking at the expiration and it's coming up, if you've got a lot of room and range, you could let it expire. Technically, it's not a big deal. If you've got a lot of contracts, you could take half off. The other approach is you could roll it. Now, if you don't mind taking the stock and you're planning to build, let's say, 2,000 shares and you only got 1 contract, well, you got plenty more puts to sell to continue to collect premium. So anyways, those are some of the things to kind of keep an eye out and watch out for. And it just really depends on your positioning in those cases. So that's what I would say. So I hope that answers kind of this question for you. Really just a matter of kind of risk and how much shares you do want to take on, and if you keep planning on selling puts. Because if it's a one-off trade, then go ahead and close the position maybe, and then collect your money and roll it maybe to another trade or another expiration. If it's something you're looking to do more longer term, then obviously, if you don't mind it, you could almost start selling the next put already to plan for getting started on the next round of trades. Anyways, hope that helps. Truly appreciate it. Check out some of the worksheets I have available. You can check out the Facebook group and also the options coaching program that I do. And I hope to see you in the next video. Thanks and take care. Bye-bye.